You're listening to Investor Insights Decoded, the podcast where our hosts, Michael Grant and Julia Foster, break down the most impactful memos from the world of investing. Today, we'll be exploring Howard Marks's memo, Who Knew?, written on the 8th of January, 1998. Let's dive into the timeless insights that continue to influence investors today. And if you're enjoying the content, don't forget to like, subscribe, and share your thoughts in the comments. Your support helps us bring more valuable insights to the investing community. Now, let's get started. All right, so are you ready to really dive into some serious investor wisdom today? We're going deep into Howard Marks's memo, Who Knew? This was written way back in January of 1998 when the Dow was just kind of hanging out at 7,802.
Yeah, that's a trip, isn't it? That's like ancient history in the stock market.
It really is, yeah.
And what makes this memo so fascinating is the timing.
Yeah.
Marks wrote this right in the middle of the Asian financial crisis.
Oh, wow.
And it gives us a front row seat to how a true master investor navigates that kind of uncertainty.
Yeah, and he wasn't just kind of armchair quarterback in this stuff,
Right.
He had actually made some pretty bold calls
Yeah.
in his previous memo about changes that were brewing.
Absolutely. In September of 97, he kind of predicted this shift in the market.
Okay.
And he acknowledged that, that how was anyone's guess.
Right.
But it turns out that the Asian meltdown hit the very next month.
Oh, wow.
And it rocked global markets.
So he kind of nailed that prediction.
He did.
I mean, was it just luck?
Well, Marx himself emphasizes that trying to pinpoint specific events is kind of trying to read tea leaves. Yeah. It's not about being right on those tiny little details.
Yeah.
Successful investing is about understanding those bigger trends.
Okay.
Probability cycles, accepting that uncertainty is just always going to be there.
So how do we actually use that?
Yeah.
As investors, do we just kind of shrug and say, well, who knows what will happen?
Well, there's a much more powerful approach than that.
Okay.
Instead of, betting it all on specific outcomes, think about it as preparing for a range of possibilities.
Okay.
And this is where things like diversification come in,
right.
Smart risk management, a long-term view. Those are the tools.
So it's less about being a fortune teller and more about building a strong foundation.
Exactly. It's like packing for a trip. You pack for rain, you pack for sunshine.
Right.
You don't just assume it's going to be perfect weather the whole time.
Right.
So Marks dives into these 3 stages of a bull market, and it's really interesting.
Okay.
So the first stage is where just a few really savvy investors, they start sensing potential.
Okay.
Stage 2, the majority catches on the market's climbing.
Right. Everyone's getting excited now.
Yeah. And then stage 3, that's where things get a little crazy.
Okay.
This is where everybody and their brother believes the good times will just never end.
Right.
It's irrational exuberance.
Classic.
Prices are totally detached from reality, risk gets ignored, and things get bubbly.
Yes, bubble territory.
Yeah, we've seen it, right? The dot-com craze, the housing boom.
Oh, yeah, for sure.
And think about this,
Yeah.
Marks wrote, Who knew? When the U.S. market was already near all-time highs.
Okay.
He was already seeing those stage 3 signs.
Oh, wow. So even amidst the party,
Yeah.
he was kind of looking for the exit sign.
He was sounding the alarm.
Wow.
Highlighting the dangers of complacency. And this is where his contrarian approach really shines, Be fearful when others are greedy, and greedy when others are fearful.
Easier said than done, I imagine.
Much easier said than done.
Yeah, because going against the crowd is tough, especially when everyone seems to be making money hand over fist.
It is, but that's often where the real opportunities lie.
So how do we actually harness this contrarian thinking?
Yeah.
Is it just about doing the opposite of what everyone else is doing?
No, it's more nuanced than that.
Right.
Blind contrarianism can be just as dangerous as, blind optimism.
Right.
It's about informed skepticism.
Right.
Questioning those prevailing narratives, doing your own homework.
Right.
And being willing to diverge from the crowd when the data supports it.
So it's like being a detective looking for clues that other people might be missing.
Exactly. You got it.
Okay, I like that.
So back in 98, with the Asian crisis happening, Marks was observing something interesting.
Okay.
The U.S. markets were holding up pretty well, even with all this uncertainty going on. And he was puzzled, Shouldn't markets hate uncertainty?
Yeah, that does seem kind of counterintuitive because uncertainty usually breeds fear, not confidence.
Right. But Marx points out this crucial distinction.
Okay.
It's not the uncertainty itself that dictates where the market goes.
Mm-hmm.
It's how investors react to that uncertainty.
Okay.
And back then, there were some really big questions looming.
Right.
How bad would this Asian crisis get? Would it spread? What would the impact be on the U.S.?
Yeah, and just like today, those questions were almost impossible to answer with any certainty.
For sure.
So what was Mark's advice in the face of all this?
Well, he said focus on what you can control.
Okay.
Your investment process, your risk management, your emotional discipline.
Mm-hmm.
Those are things you can actually shape, even when the world feels completely unpredictable.
Right.
Having a really solid framework becomes even more important when you can't know all the answers.
It's like having a compass to guide you through the fog.
Perfect analogy. And that brings us to another point that Marx makes, the danger of complacency. Okay. He says, those attractive buying opportunities, they usually don't show up when everyone's happy and their portfolios are doing great.
So when the good times are rolling, that's actually when we should be the most careful.
Precisely when everyone's feeling super optimistic, risk is often underestimated.
Right.
And the potential for something bad to happen is really high.
Right. It's easy to get lulled into this false sense of security.
Totally.
So if we're starting to feel complacent about our own investments, maybe it's time for a reality check.
Yeah, a gut check for sure.
Okay, so now let's kind of shift gears a little bit and dive into some of the more actionable insights.
Yeah, let's do it.
That Marx outlines in this memo.
Okay. He boils it down to these few key principles.
Right.
The first one is, where we stand in the market cycle. That's super crucial for making good investment decisions.
Yeah.
Be fearful when others are greedy and greedy when others are fearful.
Yeah, that's classic Marx.
Right. Second, don't chase the hot investment.
Right. Look for undervalued opportunities. Real value is usually hiding where other people aren't looking.
Okay.
So be a contrarian, but do it with good research.
Right. Be smart about it.
Don't just be contrarian to be contrarian.
Right.
Do the analysis.
Okay, so be a contrarian, do your own research, find those hidden gems.
Exactly.
Got it? Anything else?
Yeah. Third, you got to think long-term.
Okay.
And be prepared for these market cycles.
Right.
There will be downturns. There will be periods of uncertainty.
For sure.
But those are the times that often have the best opportunities.
So patience and a long-term perspective are key.
Yes.
It's not about timing the market. It's about time in the market.
Absolutely.
But this whole idea of being a contrarian, it can feel a little bit tricky.
It is tricky.
How do you actually know, when to go against the grain and when it's actually wise to just kind of follow the crowd?
That's the million-dollar question, and it gets to the heart of what Marx calls second-level thinking.
Okay, what's that? So it's not just about, recognizing what's happening in the market. You have to think about how other investors are seeing it.
Okay.
And how their reactions will shape what happens in the future.
So it's almost like a game of chess, like you're anticipating your opponent's moves.
Exactly. A first-level thinker. They see a stock price going up, and they're like, great, I should buy that stock. But a second-level thinker is going to stop and say, okay, why is it going up?
Right.
Is this justified?
But is it hype?
Yeah. Are people just getting caught up in the moment?
So it's about digging deeper, looking beyond the surface.
Exactly.
But how do we actually apply this second-level thinking? Can you give me an example?
Sure. Let's say everyone's excited about a certain sector, like electric vehicles.
Right.
Everyone's talking about electric vehicles.
Yeah, hot sector.
First-level thinker is going to just pile into any EV stock they can.
Get on that train.
Yeah, but a second-level thinker is going to say, all right, let me look at the individual companies. Let me look at their competitive advantages.
What are their valuations?
What's the long-term growth potential here?
So even within a really exciting sector, you have to be discerning.
You can't just blindly follow the hype.
Exactly. Don't get FOMO.
Don't get FOMO.
Right.
Another key aspect of this second-level thinking is understanding that the market is driven by psychology.
Right.
Marx points out that investors are often driven by emotions.
Oh, yeah.
Fear and greed. And that leads to really irrational decisions.
Yeah, we've all been there.
We have.
Letting our emotions kind of take over when we're thinking about investing.
It happens to the best of us. It's human nature.
It is, yeah.
But the key is to recognize those biases.
Right.
And try to minimize their impact on our choices.
Right.
And this is where having a really well-defined investment process
Okay.
can be so valuable.
So it's almost like having a set of rules that protect you from yourself.
Rules, principles.
Yeah.
A framework.
Yeah, a safety net.
Safety net, exactly.
To prevent you from doing something impulsive.
Yeah. And Mark says, your investment process has to be tailored to you.
Right.
Your risk tolerance, your goals, your time horizon.
Yeah, no one-size-fits-all approach.
Yep.
It's about finding what works for you.
For you.
And sticking to it even when things get a little bit crazy.
Especially when things get crazy.
Yeah.
So going back to Marx's memo in 1998,
Okay.
he was really worried about the level of complacency in the market.
Okay.
Everybody was just so focused on the good news, they weren't thinking about what could go wrong.
Right. It's easy to get kind of caught up in the good times.
It is.
And ignore those warning signs.
Yeah. So how do we avoid falling into that trap?
Right. That's the big question.
Marx says,
Yeah.
watch out for a few key things.
Okay.
First, be wary of new era thinking.
When people start saying, this time it's different.
This time it's different.
Yeah, I've definitely heard that before.
Classic sign that investors are just way too optimistic.
Right.
And they're justifying these crazy valuations based on the belief that the future is going to be completely different from the past.
Right. But history tends to rhyme even if it doesn't repeat exactly.
That's right.
Okay. So be skeptical of new era narratives.
Yes.
What else should we be watching out for?
Marx also says, don't chase performance.
Okay.
When you see certain assets or sectors that are doing really well, it's so tempting to jump on that bandwagon.
Right.
But remember, past performance is not a guarantee of future returns.
So don't get caught up in FOMO. Do your own research.
Yes.
Make sure you understand those fundamentals before you invest.
Couldn't have said it better myself.
Okay, yeah.
And finally, Marx stresses the importance of paying attention to valuations. When prices are way higher than historical averages, could be a sign that the market's overvalued.
So even when things seem great, you got to dig a little deeper.
Absolutely.
And make sure those fundamentals are actually supporting those prices.
Make sure the story checks out.
Right.
Remember, the best time to sell is often before everyone else realizes it's time to sell.
That's a tough one.
It is.
So it's about being proactive, not reactive.
Proactive, not reactive.
That's it. But even with all these insights from Marx, it still feels like a judgment call.
It is. There's no magic formula.
Yeah.
There will be times when you sell too early.
Right.
And you miss out on more gains.
Right.
And there will be times when you hold on too long and you watch your profits disappear.
Yeah, that's just the nature of the game.
It is.
So even with all the wisdom we've gotten from Marx's memo, there's still this element of uncertainty and a need for individual judgment.
You got it. Investing is not a precise science.
Okay.
It's an art.
Okay.
It takes knowledge, skill, experience, and a whole lot of humility.
So how do we actually reconcile this need for both analysis and intuition? How do we make those tough decisions when there's no clear right answer?
That is a fantastic question.
Yeah.
And it's something that Marx himself wrestles with.
Okay.
He doesn't have all the answers.
Right.
But he gives us a really good way to think about these complex issues.
Okay, so I guess we're going to have to keep listening to find out more about that.
You got it.
Okay, so we're back to this, big question.
Yeah.
How do we know when to sell?
Right.
Especially when, everything seems to be going great.
Yeah.
That's the real head scratcher.
Yeah, it's like the million-dollar question, isn't it?
It is.
As we've been saying, Marx reminds us markets move in cycles.
Right.
What goes up must come down.
For sure.
But knowing the exact timing of when things are going to turn, that's incredibly difficult.
It's like trying to predict when the tide's going to turn.
Exactly.
Yeah.
And Marx isn't saying we should try to time the market perfectly.
Right.
That's a fool's game.
Yeah.
Instead, he says focus on recognizing the signs.
Okay.
When investors are getting overly optimistic, when valuations have become detached from reality.
So it's more about sensing when the market's getting ahead of itself.
Yeah.
Not necessarily predicting the exact date.
Right. You're not going to call the top.
But it's all going to come crashing down.
Exactly. He says that when investors get complacent and they fall into that things can only get better mindset.
Right.
They're not seeing the risks.
They're missing the warning signs.
Yeah, they're ignoring them.
So what are some of those warning signs?
Wow.
What should we be on the lookout for?
Marx points out a few things.
Okay.
First, watch out for new era.
Thinking.
Yeah.
You mean when people start saying, this time it's different?
This time it's different, yeah.
Yeah, I've definitely heard that one before.
It's a classic.
It is.
And it's usually a red flag.
Right.
It means investors are overly optimistic. Yeah. They're justifying high valuations based on this belief that the future is going to be completely different from the past.
Right. History tends to rhyme, though.
It does.
Even if it doesn't repeat exactly.
Yeah, rhymes.
Okay, so be skeptical of new era narratives.
Yes.
What else?
Marks also says don't chase performance.
Okay.
You see certain assets or sectors doing really well.
Mm-hmm.
It's tempting to jump in.
Yeah, FOMO.
Yeah, but remember, past performance doesn't guarantee future returns.
Right.
So don't get caught up in FOMO. Do your own research.
Right.
Understand the fundamentals before you invest.
Solid advice.
And finally, Marks says pay attention to valuations.
Okay.
When prices are a lot higher than historical averages, it could mean the market is getting overvalued.
So even when things seem really great on the surface, you got to dig a little deeper.
Absolutely.
Make sure those fundamentals actually support the current prices.
Exactly. Remember, the best time to sell is often before everyone else realizes it's time to sell.
That's tough.
It is.
Yeah.
But it's about being proactive, not reactive.
Right. But even with all this from Marks, it still feels like a judgment call.
It is. There's no perfect formula.
Yeah.
There will be times when you sell too early and you miss out on gains.
Right.
And there will be times when you hold on too long and you watch your profits disappear.
Right.
That's just part of the game.
So even with all this wisdom from Marks, we still have to use our own judgment.
We do. Investing is not a precise science.
Right.
It's an art.
Yeah.
It takes knowledge, skill, experience,
Yeah.
and a lot of humility.
So if we could just like sum it all up, what's the one key takeaway from Who Knew?
I think the most important takeaway is to have a healthy skepticism.
Okay.
Don't just blindly follow the crowd.
Right.
Do your research, think critically. Be willing to go against the grain when the data supports it.
Okay.
Remember, the greatest opportunities often come up when other people are scared.
Right.
And the biggest risks are there when everyone is complacent.
That's a good reminder.
So next time you're feeling really good about your investments, take a step back.
Okay.
Ask yourself, am I being complacent? Am I overlooking risks?
Right.
What would Howard Marks do?
Yeah, that's a great point. What would Howard Marks do?
By embracing that contrarian mindset and focusing on what we can control, we can navigate the market's ups and downs and reach our long-term goals.
This has been a great deep dive into Howard Marks' wisdom.
It has.
If you want to learn more, I highly recommend you check out his memos and his books.
Yeah, there's so much good stuff in there.
Yeah, they're definitely worth a read.
For sure.
Until next time, happy investing.